Now we want to look at what is happening in the U.S., some GDP forecasts, some pressures on wages, where are prices right now, and what do we expect going into the end of Q3 and then more importantly into Q4. So when we look at what are some of the expectations for economic forecasts, I think this is just an interesting backdrop when we look at quarter over quarter, Q2, and Q2 is looking at about 9%. So we were saying that 10% was a little high. Maybe I think even 9% might be a little elevated, but we did get a decent amount of new stimulus, so that could be some support. The question is going to be, what does Q3 look like? And that's when we start turning to COVID variants. What is happening on the inflation side? And you can see that it's been fairly stable. But one of the things that we've seen is some softness coming in. The question, though, is how much of it is going to be real growth? Because if we have, let's just say, for an example, we have inflation of 5.5% and we have growth that comes in at 7.5%. Well, I'm sorry, 6.5%. Well, you really only had growth of 1%, which again is nothing to sneeze at based on what we've seen, but just shows that we're coming to this exhaustion point of trillions upon trillions of dollars getting pushed into our market with very limited impact to the underlying consumer, where it has just essentially driven financial assets higher and really hasn't done anything for wages. It's created these bubbles that have not gone to people's wages, that haven't gone to their salaries, their hourly benefits. And these are some of the underlying problems, because they're shooting liquidity from a fire hose, but it's not doing anything for the people that actually need it. It's actually creating more problems for the people that need it. And that's where we continue to see this lack of understanding of from politicians and on a fiscal and monetary side in terms of how to drive this change and really create some sort of benefits for the underlying individual. And then when we look at, we've talked about this time and time again. We did a backdrop in segment 1 on Iran, social unrest, but higher inflation increases social unrest. That's just, they move in lockstep. We wrote articles about this. We've done shows about this. We've done our client insights. We keep talking about there is a tie to inflation, homicides, social unrest, because people feel left behind. They can't afford things. Then they're willing to do the unthinkable in order to feed their family. In order to move ahead, which again becomes a much bigger problem when we look at how this is going to progress over time. Which is why, and at the same time, we also can remain on the side that this is not transitory. Instead, some of these price increases are going to be replaced. So when we think about how are they going to be replaced, so B2B or BSB, I'm sorry, on Twitter was kind enough to bring up the question of, would you rather have electricity or natural gas as your cooking fuel? And I think this is an important backdrop, because when we look at very low income, and middle income, we don't appreciate how people utilize and cook their food. So in very low income, it's crop waste and dung, poop. They use feces to try to generate fuel in order just to cook, to feed their family. So then when you go on the wood side and we consider about deforestation, everyone likes to talk about lumber and all of these problems, but what about those that are just cutting down wood so that they can cook their food to feed their family? And then you start getting into charcoal and coal. Well, there's got to be a way to increase the utilization of natural gas and increase the utilization of LPG. Do things, or even coal to that point, based on what are some of the other opportunities and other options. There are ways that we can try to address this and without trying to rip apart the atmosphere, without trying to burn wood and cut down trees. We like to think we're so far and away above the rest of the world because we're going to use electricity because natural gas is damaging. Well, what about the other 7 billion people that live outside of the US? What are the other 4 billion people that live within that very low to middle income and probably higher, probably closer to 5 billion? There is something to be addressed that can have meaningful impact instead of forcing 100,000 homes in the United States to be electricity instead of natural gas. And this is just something that I like to zoom out sometimes, because we always zoom in so focused, and it's like, oh, well, look at New York State. And it's like, okay, well, New York State is how big or how much of the global planet. Let's think big. Let's really talk about this and have a serious conversation and how to address a lot of these underlying problems. But those are things that I think need to happen on a go-forward basis. So then when we look at, well, how are we going to do that? How is it going to be funded? Well, let's look at how things are being funded right now. And funding ratios improved across both private and public funds. So somebody has brought up, and for those that weren't here for 2008, a lot of the bailouts were to protect pension funds, because pension funds were continuously going down the rabbit hole of risk because they weren't getting a yield out of the 10-year, 20-year wasn't really that popular or really available, but 10-year and 30-year. So they started to go down that risk. So when you look at the funding ratios on state and local governments, here you can see just how damaging '08 was. And they've struggled to come back to that funding ratio after seeing that come down. And it's because rates are so low. If you have higher rates, you have an ability to get risk-free capital and not have to worry about some of this. But you can see both are still struggling. Now, unfunded liabilities recovered to 2018 levels, but 2018 is still below 2008. So we still have a problem that is getting to a point of absurdity, because we need to either tell these pensioners we were telling you 4% returns, it's really 1.5%, but that would cause chaos, because then they won't have the ability to live the life that they thought they were going to live, which is where we continue to see these funding ratios weaken, still remain under pressure. But this is really the part of the original bailout of '08 that has now been so perverted and morphed that you're creating so many funding problems going forward because the risk-free rate isn't there to support a lot of their investments. So then when we look at, well, private equity, private equity always likes to jump in. They work very quick to jump in to this real estate game. And what did they do? They drove down prices. So now returns are weaker and weaker. And what does that mean? That means that they have much less room for error. And that's where things have continued to struggle with multifamily buyer demand by investor type. You can see that the private equity side in Q2 of 2021 was almost 76% of all sales. Then when you look at just the value of private equity purchases, we're coming almost to $1 trillion of the actual value that has come into the market. On a debt to EBITDA ratio, that's at 7 times. You're looking at more and more pressure as returns continue to dwindle. And when you look at the multifamily returns to revert back to global financial crisis levels, you're going to see those returns. So they bought up, creating less of this problem. But the view is that rents will be supported, which will help essentially drive some of these multifamily returns. Again, they're not wrong in thinking rents are going to go up, but what you are paying for it is going to become a much bigger problem and eat into those end of returns, which is why we've tried to avoid some of the real estate issues that we've seen. There's still some opportunity when we look at farmland, when we look at some of the development side, but this is just something that we've seen, which is why when people talk about private equity, they've been coming in and buying up these hand over fist. But what have we seen in general? So we continue to see a divergence in wage growth. So we had the first quartile bounce a little bit, still down from that high level, but the fourth quartile is coming back into the lows. And this is where, when we look at how a lot of this cash is being moved into the market, and you're seeing all of these supply chain issues and all of these other problems in general, you can see that there's this bifurcation of both. All quartiles are under pressure, and the cost of their stuff is going up, and the wages are not keeping pace, which is just hurting their just quality of life, which is why we continue to say that they're just not going to buy the same amount as prices keep going up. They're going to have to choose durable goods or services. So that's why, again, durable good prices will come under pressure. Demand for those are going to come under pressure, but you're going to see that revert higher for the service side. And what is it doing? Not only are we seeing an increase in inflation, but a decrease in wages, which is eating into consumer confidence. So when you look at the sentiment index is down, when you look at expectations. So July sentiment was down to 80.8 versus an 86.5 estimate and 85.5 prior. Current conditions fell from 88.6 to 84.5. Expectations fell from 83.5 to 78.4, with 1 year inflation expectations up to 4.8% versus the previous 4.2%. So again, you're seeing these pressure points continue to mount, and not only are wages not keeping pace, but you're also seeing that eat into sentiment as extended benefits go away, as some of these individuals are going to be forced back into the market and are going to have to take a cut in pay just to get some work. But even if it's at the same hourly rate, that hourly rate just isn't going to go as far when you're looking at spending. And when you look at mobility in terms of, mobility within your career, this just highlights, food and customer service, cleaning services, personal appearance, transportation and production, assembler and machine operators. The share of internal upward transition is muted. Share of upward transitions in general is muted versus some of these others. So your projected growth. So when you think about these individuals that are struggling on an hourly wage, they're really not seeing the same type of increases, and they make up a large part of where some of these growth, healthcare, transportation and production, food and customer services, these are areas. And then when we look at administrative and professional services, which is another big side of the equation, you can see that advancement is actually getting worse versus getting better. And the sales and management, when you look at share of internal upward transitions, those are small. But if you think about sales, a sales manager gets paid less than a salesperson who's getting a percentage of sales, so that can go both ways. But this is just showing, again, these pressure points and how more and more people are falling into that bottom quartile, and they're just not seeing that upward mobility. Social mobility, inequality grows, which again continues to be some of these outlier problems that are arising and putting pressure, which is why. But with all of this being said, U.S. household debt service ratio and U.S. total financial obligation ratio is getting better, in the sense of people are paying off credit cards, they're paying off mortgages, they're not sitting on as much debt, but it's not ubiquitous. It's something that is highly concentrated to the top end of that sphere of, let's call it the top 20%, and even more so in the top 10%. So even though the ratios look better, it's very much weighted to the individuals that had their savings increase, as we've shown the chart 5 times now, that look at all of it being weighted towards that top end, because the lower 50% of the U.S. only saw savings increase by 50 billion versus the quoted 13.7 trillion. So again, there's that huge difference between the two, which is why weekly personal finance index got worse, because this is looking at things on a broader scale and utilizing what are current financials based on salaries, wages, benefits versus what those prices are, which continue to come under that pressure. All the while, when we break down where are we seeing this pressure point, look at first quartile is bouncing, still not pre-COVID, but bouncing. And let's look at everyone else. Second quartile, third quartile, fourth quartile. All of them are actually coming into the lows of COVID. This is the problem that we keep talking about. Wage growth is just not showing up. Even though there's a lot of people out of work, but there's also a lot of jobs available. Why aren't we seeing some of this pass through of wage increases? We're getting some spits and starts, but again, this is just looking at some of this growth trajectory that remains a problem when you think about overall ability to spend, which is when we look at percent of individuals with zero wage change. You can see the zero wage change is right where it was when we entered pre-COVID. Like we're in a point in time where we're just not seeing progress towards just people getting, seeing wage growth. And that's when you start looking at median wage growth. We've essentially flatlined, which is a problem when you just look at the cost to the underlying individual, which is where looking at this last time, just a way to look at it, real average hourly earnings for production and non-supervisory employees decreased 2.2% from June 2020 to June 2021. The change in real average hourly earnings combined with an increase of 0.6% in the average work week resulted in a 1.6% decrease in real average weekly earnings over this period. The Consumer Price Index for urban wage earners and clerical workers rose 6% for the year ending June 2021. So you have wages decreasing 2.2% and cost increasing 6%. Just think about what that looks like and what those pressures are in general. So then when we look at 50% of small business report hiring struggles. Why are we struggling to hire? Because they're not increasing wages, and people see the news, they see some of these different capacity, and you're not seeing these individuals come back, which is why businesses are not increasing wages. But at the same time, to their defense, how can you increase wages if all of your costs are up? You're already pushing through maximum price increases. How are you going to increase prices further by hiring someone at a higher wage, which is why we're seeing this kind of difficulty between the two. So then when we look at unemployment benefits prevented 13% of unemployment recipients from accepting jobs. So as we see these benefits go away, if they haven't expired yet, they expire in September, we'll start to see some of this come back. So we should, based on what we're seeing, we expect to see some slowdown of hiring, and it'll still be up, but just pace of hiring in July, August, and we expect to see some of that start to increase in September and October. Now, almost 50% of homemakers that left jobs during the pandemic plan to return to work in the next 3 months. So this is also a positive in terms of where this is, but what is summer? Summer is people have, kids have school off. So as kids come out of summer vacation back into school, that will allow some of these individuals to go back to work. And this is going to be that additional bump as we go into the fall months. Now, the potential re-entrance could boost labor force above pre-pandemic levels, but at a lower wage or at a stagnant wage, which again becomes a bigger issue when you weigh that against where current prices are and where current prices are going to go. So let's look at what's being rejected. So buying conditions for large household durables, terrible, not surprising. Vehicles, terrible. Why? Because prices have exploded. So people are either not going to buy or are going to delay their buying. But the age of vehicles is getting long in the tooth. We're now at an average age of 12.1 years on cars on the road, which means that there's going to have to be that replacement, which is going to be very difficult given where the shortfalls are, where prices are. And that's going to be some of that back and forth as to what wins out, while household durables is going to remain under pressure, as we showed earlier, because they're also part of some of the biggest hiccups on the supply chain side. So now let's look at the interest rate related to buying a home coming into the lows. Price-related buying conditions for houses are at all-time lows, because when you look at prices have continued to rise, continued to go up, and they've now hit a point of consumers going, nope, I'm not paying that price, and I'm not getting into a bid war. So we're starting to see price cuts, because people are like, all right, well, I guess we missed the bubble, or I should say the top of the bubble, but we can still sell our house. It's just not going to be for that extra $24,000 that we've seen. It'll still be well above where we bought it for, but not at the extremes that we've seen. And this is just showing an example. So loans with appraisal waivers by guarantor, that's starting to come down, which just means that essentially banks are saying, look, if it doesn't appraise, we're either going to reject it or we're only going to give you a mortgage for that percentage and you have to make up the difference on cash. And that's happening on both sides in terms of GSE loans with appraisal waiver by guarantor and share of GSE loans with appraisal waiver by loan purpose. All of them are starting to roll. You're starting to see that because we're starting to get to the point where everyone's like, oh, okay, guys, time out. Let's look at prices here. How absurd is this? And how do we adjust to protect from some of these additional increases? So then when we look at June housing starts, so June housing starts were stronger than expected at 6.3% versus an estimate of 1.2% and 2.1% higher in the prior month, revised down from 3.6%. Building permits were much weaker, though. Expected they came in at negative 5.1% versus an estimate expected of 70 basis points higher. So you're just having permits coming down and private housing unit starts going up as we're starting to see raw materials normalize a bit, things starting to catch up with themselves. So now you're getting permits coming down and you're starting to see the permits go into new construction. And that's showing with just the home builder index. So when we look at the confidence, so home builder confidence slid to 80 versus an estimate of 82 in June, still elevated, but down from its peak in November. Prospective buyer traffic was much weaker at 65 versus 71 in the prior month as builders are still grappling. But when you look at buyer interest, it's from all-time highs to just very high. So we're still well over the highs that we saw in 2005, but you're just seeing some moderation, and this is what we keep coming back to. Who's the next incremental buyer? And what is the credit quality? Well, we've been saying the credit quality gets a little bit worse. As the credit quality gets worse, that means that you're not going to provide waivers on appraisals. These are some of the different shifts that we're seeing. And the university buying conditions for houses is at the lowest it's been since 1982. Again, not surprising given where prices are, which is then when we look at it a little bit differently, U.S. consumers' housing market search activity has cooled off because prices are so high. So you're at a point now where, and if you think about the summer, like when is the best time to sell a house or buy a house, so, in terms of volume, but spring and summer. And as we come into those peak periods, you're seeing a big drop off in just activity as people are waiting for some of those prices to moderate. And the MBA purchase. So the MBA purchase limited optimal blue have continued to come down as you're starting to see some of these pressures come in over just new MBA mortgage-backed mortgage assets. So then when we look at Redfin home buyer demand index was up 15%. So it's still higher. So home buyer demand is still there. It's just when we look at it from not so much the demand side, but the pricing side. So over 4% of listings had price drops. So we're actually starting to see prices come down a bit because they're like, all right, well, we thought we were going to get that extra 4%. But let's just cut it and get people in the door, and then maybe there'll be a little bit of a bidding war, and we'll get 2% and not that additional 4%. And that's when we look at U.S. pending home sales still are at a record when we look at it over that time period, which again is pointing to some of that just the amount of activity that remains in the system. New listings per month still moving up to the highs. It's the highest in September of, sellers are listing homes at a monthly rate not seen since September 2019. Again, not surprising. It's just at a slightly lower rate. And then the median list price is still elevated, but when you look at it, is actually flattening and has come down a bit by about 4%. So then when we look at National Single Family Rent Index, the rent index is exploding. And it is now above where it was in 2006, which is why we continue to talk about the replacement value of CPI when you have durable goods coming down, but now you have rents going up. And this is going to be the flip that is going to support and keep that CPI elevated. Now, in the next segment, we're going to go into more detail on some of the underlying components that we're seeing that are going to keep some of these prices elevated, and what do we see for some of the shortfalls within the U.S. economy.